Good morning, everybody. Hope everyone can hear me. My computer's having an off day and I can't put the PowerPoint on full screen. So apologies for that, but hopefully you can all see what's on the screen at the moment. Haven't had a power hour for a couple of months, so welcome back everybody who is a regular watcher. We'll try and get them back on track now. Obviously, apart from when PlantWorks is on. Really pleased today that we're welcoming Chris Slight back from Off-Highway Research. We've got one of the highest registrations ever, I think, and Chris is always incredibly informative, and I know from their subscribers list are very influential. For those of you who don't know me, I'm Joanna Oliver. I'm Director of Global Programmes for the Construction Equipment Association. Very little global at the moment, thanks to the government, who seem to have withdrawn all funding for export, and they've even slashed their own budget for their export staff by 60%. So I think we're going to be looking at ways that the CEA can actually improve our international content, but have to do it self-funding because despite Brexit and the world being our oyster, the world now seems to have shrunk to a small barnacle. Anyway, that's probably enough politics from me. Rules of the CEA House, held in accordance with the CEA corporate compliance rules, a copy of which are available on our website, should you need some help sleeping. The webinar is being recorded. If anybody has an issue with that, please drop out now. Please stay on mute. If you'd like to ask a question during the presentation, please use the chat box. If we're in the open Q&A session, please just raise your hand. Please do not have your video running during the presentations, as I know some of you are on reduced bandwidth, and we're doing our best to make this thing work. As I've singularly failed by not being able to get this on the main screen, but hey ho. Before I introduce Chris, hopefully you've all booked your stand at PlantWorks, which is the largest working construction event, as well as other events for construction equipment in the UK this year. The working element, if anybody hasn't been, you can, as an exhibitor, demonstrate your machinery to its best advantage. You can dig big holes, you can fill them in, you can have big piles of earth, drive up and down them, do whatever your machine does. And if people have a correct registration as an operator, they can also have a go and try before they buy. We've got a few new things at PlantWorks this year. I'll just quickly run through the Operator Challenge, which is run by awesome earth movers and sponsored by Hyundai. That's the chance for construction equipment excavator drivers to come along and show us just how good they are, and that will be in the main ring running throughout the week. And I think there's some pretty amazing prizes to be won on that. Full details of all this are on the PlantWorks website. This is a new idea, following on really from what we learned from FutureWorks last year, is that there are a lot of companies who are very much at the ideas stage or the pre-production stage. They've got some really good concepts which may still be on the drawing board, but we're giving a lot of startups, SMEs and companies that are not ready to exhibit themselves at PlantWorks, that they can have a table, some graphics, access to a computer point, and they can just come along in a big ideas area and show off their concept. We're working with HS2 to make this happen, and HS2 are bringing what they call their accelerator companies, who are exactly the kind of company I've just described. They're bringing a fantastic new technology. I mean, we've said, you know, game-changing technology, particularly in the telematics, AI, connected plant fields, but if you've got something that's going to make the use of construction equipment better, either in the production process or on the job site, the Big Ideas is a really good low-cost option, and it will put you in front of the great and the good in the construction industry. So if you're an OEM, if you have some suppliers that you work with or people that you've met and would like to work with that have an idea, please put them on to me and I will see what I can do. We're limited to 12 spaces and we're already rattling through those. So that's something to take away. Aiming for 300 exhibitors at Plantworks this year. More would be good, and we're already, I think, 78% full. We've got some big names there. So again, details on the website. And the other new zone is the Get Connected zone. That's showing off the latest in autonomous plant and AI, and there will be the area in the inside hall showing how the machines are being connected in an outside area. So again, technology that's new since we had Plantworks in 2019, and it's incredible how the industry's changing so much in the 4 years since we last had the show. So much more technology and so much more cooperation, collaboration between the big manufacturers and the tech people, and then on the data that's coming out of the telematics. Okay, so that's enough for me. So welcome back, Chris Slight. Always a joy to have you. I've known Chris, gosh, I think he was still in schoolboy shorts the first time I met him, so a very long time ago. Chris is Managing Director of Off-Highway Research, who are great friends of the CEA. They are always there to help us if we need specific information on different markets. And Chris is going to give you a canter through the current state of the global construction equipment markets. So I will shut up, stop sharing, and hand you over to Chris. Thank you.
Lovely, thank you, Joanna. Very kind introduction there. I can assure you that although you're seeing me from the chest up, I am wearing my schoolboy shorts today, just out of a sense of tradition. Let's attempt to screen share and get things started. We learned a few new words trying this just before everyone came on, so here's hoping. Are you seeing my screen there?
Yep.
Yeah.
All good.
Okay, excellent. Yeah, so as Joanna said, I'm going to just try and run through some of the key points and the highlights of what we see in the global construction equipment markets. It really, in the time available, I can only kind of offer the headline figures, but there is, as Joanna said, the opportunity to ask questions. So if you have any, do type them into the chat box and we'll get to as many as time allows. I think many of you will be familiar with off-highway research, but for those who aren't, we're a specialist in market research around the construction equipment universe. And as a specialist, we're the largest of its kind in the world. Started life as part of the Economist Intelligence Unit, and through various changes over the years, we're now owned by KHL Group, which many of you will know as a leading media group in the international construction space. Magazines like International Rental News, International Construction, Construction Europe, all under that banner. As off-highway research, we have our offices in strategic locations, really to try and be close to the industry. I think, you know, the one I would highlight there is that we're now operating in South America through an office in Chile. We've started to produce reports on South America, and we'll be expanding that service later this year. And in addition to our own offices, we have a lot of locations and contacts available to us through the parent company's network. So just the one slide of rubric, and then I'll get into it. In this presentation, I'm going to be talking about the market, and everybody has a different definition depending on, you know, what areas your company is in, what's of interest, and the kind of products that you participate in. From off-highway point of view, when we talk about the market, we're talking, of course, in specific terms about the machine types we cover, which are listed up here on the screen. So it probably won't, the absolute number probably won't match anything that you kind of view as your market, or will have an exact sort of correlation. But where I would expect and hope to see a correlation is that the ups and downs, the drivers that we're going to discuss, and the outlook particularly, should correlate, and you should sort of see a connection to what's important to your business. So just to start at the top with the global market, really the life since 2020 has been unusual, I would say, with the COVID pandemic. Although initially when that struck, there was a downturn in most markets. We have seen with the low interest rates that came with the pandemic and the global stimulus, that sales really roared ahead in 2021. Absolute out-and-out record demand grew 10% worldwide, which is an unusually steep climb from what was already quite a good level. So that was the high water mark. We're still in the situation, I feel, where order backlogs and lead times remain high. It's certainly been a talking point for the last 2 years. And while things do seem to be improving, they're probably not back to normal levels yet. I think it's going to take most of this year for that to happen. Oh, someone needs to go on mute there. So last year, we kind of saw a slightly mixed picture, and I'm going to come on to this, really, that we see a unique situation in China, which has its own cycle and its own drivers. So the Chinese market fell very steeply last year. But if you looked at the world excluding China, there was still pretty good growth last year. That part of the world, taking China out of the equation, saw a 7% increase in sales last year. We would describe the market as now heading for a soft landing, and I'll go into a little bit more detail about what that means. But the way I would characterize it is, yes, we will see a downturn on a global level and on many regional levels this year. But I think what we'll continue to see is volumes at a very, very good level. And I think the main reason for that is the thing that's pulling down demand really is the increase in interest rates, which feeds through quite quickly to house building. So that does tend to affect the volume equipment, the compact machines. But at the same time, we're seeing very strong infrastructure markets as a result of those stimulus plans that were put in place, and which are now leading to projects really taking place on the ground, and work that is over and above what we would have expected without the COVID and the resulting stimulus. And there are, of course, headwinds in the world, and I don't really need to go into details of what they are. It's the situation we're seeing in terms of inflation and interest rates, and of course that is exacerbated in Europe by the ongoing conflict in Ukraine. But that's bringing with it a general economic slowdown, which will affect demand, although, as I'll go on to say, not too steeply. Before I get into our figures, I just want to take a slightly different look. One of the ways that we try and follow things and monitor things on a quarter-by-quarter basis is look at all the companies in our industry that are stock market listed and therefore have to produce quarterly financial results. So that's exactly what you've got here. We have 19 or so major international OEMs that are listed on the various stock markets around the world. And this plots effectively a quarter-by-quarter trend of what's going on in the market. These burgundy columns are revenues. So you see, going back to 18 and 19, a cyclical peak. Things were turning down at the end of 19 before COVID really struck. And that's one of the interesting things, that we're expecting a sort of a cyclical downturn from 2020 onwards. We, of course, had a very deep dip as COVID hit the world and the world went into lockdown. But very quickly things bounced back. Demand was very, very high for reasons I've explained. And really revenues have gone from strength to strength ever since. There are a few bumps along the way because it is a seasonal market after all. But you see where we ended in the final quarter of 2022, by far and away the highest revenues this industry has ever seen for a quarter, and that's following on a series of records throughout the year. So very, very strong in terms of volumes and revenues. What hasn't been so good, or is what's been a bit more mixed, has been the what's been happening with profitability and margins. If you look at the last peak, 2018, 2019, this grey line shows the margin over on the right scale. So when the market is on a high, you expect margins, operating margins of 12 to 14%. It's in this sort of COVID and post-COVID upswing, margins like that haven't really quite been achieved. It's sort of touched on 12, 13% at times, but not really been that well sustained. And the margin in the industry did dip again somewhat in the first quarter. So that obviously illustrates that it hasn't been all plain sailing. And the reason for that really has been the inflationary pressures and the supply chain issues that we've seen in the world. Manufacturers are obviously seeing much bigger costs at their factory gate, and it is more difficult to pass them on to customers when they're going up so much and so quickly. So yeah, that's the picture we see at the moment. We're obviously just entering the results season now, so we'll see where the first quarter takes us, not just in terms of revenues, but the new order and the order backlog position is possibly more important at the moment. So moving on to our numbers, again, a very long scale here, and I've done this so you can kind of see the cyclicality of the industry. It has been very unusual, really, in the last 15 years, because in 2008 and 2009, you had this very abnormal downturn because of the global financial crisis, then a steep bounce back because of the Chinese stimulus spending, and then a sort of a period where other markets were limping back to health and China was falling rapidly. So it was only really in the late 2010s that we got back onto a more sort of normal footing. And as I said, in connection with the previous slide, the cycle rose 2017, 18 and 19. We were expecting a downturn in 2020, but because of all the stimulus spending, again, particularly in China, the market grew a bit. And then in 2021, all the countries of the world really got on board, and you saw this really quite remarkable peak. So the global market, as I said earlier, fell in 22, but it was entirely due to what happened in China, and most other markets continued to grow. So you're kind of in this mixed pattern at the moment, which indicates a bit of an inflection. And towards the end, I'll come on and talk about our forecast and where we see that going. First, I just want to dive into the regions, and looking at Europe first. The picture that we see in Europe is similar in many parts of the world, but let's jump into it. Again, you know, very long scale, kind of seeing the cycles, the ups and the downs, and really this period from the mid 2010s onwards, we saw quite strong growth when the majority of the problems related to the global recession had kind of worked themselves out with the debt crises and what have you. And we saw pretty strong growth. There was a downturn in 2020, as most markets indeed saw a downturn because of the pandemic and the lockdowns. But then this sharp bounce back, and then things moving it up ever so slightly again last year. I think the point about Europe, and again, most markets, is sales were already at a pretty high level in 2021. The only time Europe had been higher was back in the 2000s, and we would view that period as very clearly an overheating of the market. Things grew very quickly and then fell away quickly. We see things differently now because this growth has been quite steady, so we feel it's built up to a new sort of higher, more natural level. However, interest rates are beginning to bite in house building, and many of the individual countries in Europe have very clearly reached a peak and are more or less saturated and can't go much higher. So looking ahead, we do see a modest downturn in the European market. Really not all that steep if you kind of look back at the ups and downs that we've been through in the last couple of years. it does look quite similar to the downturn that we had in the early 2000s. So nothing too severe. And the difference being between now and the early 2000s is that we see volumes really at a very high and strong level. The composition of the European market has changed quite a bit over the years. If you go back to the 90s, there were some traditional products like backhoe loaders and skid steer loaders, which sold in reasonable numbers. And what you've seen over the years is a bit of a transition away from backhoes and skid steers, more towards mini excavators and midi excavators, which would be in our crawler excavator segment. And a few more telescopic handlers, compact wheel loaders kind of coming into the market. Wheeled excavators are an odd one. They're extremely popular in certain markets like Germany and France and part of the Nordic region, not so much in others, but that's a fairly steady part of the market. So you have seen this transition since the 90s, and particularly in the last 10 or 15 years, where these traditional products have fallen away, and it really has become a mini excavator, wheel loader, telehandler market. We also look at sales by customer type, and in Europe it's quite a diverse customer base. The big ones are contractors and rental, shown here by the red and grey bars there. Each of those is about 35–36%. It kind of varies a little bit year to year, which is the biggest. It depends somewhat on which markets are in the ascendancy. So if somewhere like UK is very strong, obviously the UK is very much a rental dominated market. That's often enough to tip the balance on a European level towards rental. At the moment, the sort of the contractor side is somewhat bigger, by about a percentage point. And that's really because the strongest growth that we've seen in the last couple of years has been in Southern Europe, particularly Italy is the one that matters in terms of volume. And in Southern Europe, you do tend to get contractors rather dominating as the main customer group. The other ones that are perhaps not as obvious, in this yellow band here is extraction, so that's quarrying and mining. That's quite low in volume terms. This is unit terms, so number of machines sold. But of course, those industries do tend to take the biggest equipment in terms of excavators, loaders, and dump trucks, and so on. So if you did this analysis in terms of value, you would see the extraction industries being more significant. However, in volume terms, you have things like agriculture and landscaping being quite big areas. But of course, you're talking about relatively small machines in those areas. And the other areas that we've identified as significant are things like waste management and recycling. You get a few machines sold to public sector, and you get a few machines sold into general industrial applications. So looking at North America, it's not the drivers are pretty much the same as we've seen in Europe, but what that's meant in terms of the equipment sales is slightly different. But again, similar sort of thing, the low interest rates have really driven compact equipment sales, and now we see them falling away in favor of heavier machines. There's a lot of talk in North America about the stimulus bill. It's $2 trillion, which is more money than anyone's brain can really comprehend. We don't see that as driving a spike, particularly pushing machines up very steeply. We don't really see that. But I think what it will do is provide a lot of stability and certainty for people to invest and renew their fleets. This chart is a little bit more colourful than perhaps it needs to be. The point here is we've changed a little bit at Off-Highway Research. We're now doing our own more detailed research in North America. So we're reporting USA and Canada separately, whereas before we worked with a partner and just got a consolidated North American figure. So hence all the colours. But yeah, you see a similar-ish pattern to what we saw in Europe, a bit of a downturn in 2020, although not as steeply as was seen here, and then a very, very robust rebound in 21 and 22. 2022, by far and away the highest volumes that ever been seen in the industry. But one of the reasons it was a high volume is it was very, very heavily in the compact equipment space, as I said, driven by house building. We see things leveling off or dipping a little bit this year. And the reason for such a shallow decline, just a couple of percentage points, is that although interest rates are going up and you're seeing house building activity slow down, there's still a very big pipeline of work in the house building space that we think will continue to stimulate sales this year. And the other thing is that with the order backlogs and the lead times being what they are, even if companies, stop taking orders tomorrow, many of them are sold out for this year. So in a sense, that big backlog almost guarantees volumes. For some companies, people are understandably cagey about this, but the lead times and backlogs mean that whatever happens in terms of new orders this year should be very, very strong. And then obviously the downturn is a little bit steeper in the latter years of the forecast. But again, as I was saying, looking at the European market, this is an analysis by units, and what we expect to see is a bit of a pivot towards the heavier equipment. So if you did this analysis in terms of value, the downturn would not be as steep, or it might not be a downturn at all. The structure of the market in North America is a little bit different to what we see here, and it has undergone some more fundamental changes. Back in the 1990s, the only type of compact equipment that was sold was the skid steer loader, that was sold in very big numbers. But that accounted for about a third of the market. What you've seen in the last 30 years or so is first mini excavators becoming established, and then compact track loaders, which are essentially just a tracked variant of the wheeled skid steer loader. And what you've seen in the last 5 years, and particularly in the last 2 or 3 years, is that sales of compact track loaders have really rocketed, replacing skid steer loaders to a great extent. And you've also seen growth in mini excavator sales. So that, as I've said a couple of times, that's all about house building, really. Although this compact track loader space, we think, is also, the growth has been so strong because it's also mechanizing other areas of the industry which perhaps were manual labor or less mechanized than before. And what that's done to the market is gone from this situation in the 90s where only about a third of the equipment was compact equipment to more like 50, 60, at the peak, maybe 2/3 of the machines sold in North America were these compact sizes. Of course, you don't get that kind of growth without something kind of losing out. And again, as in Europe, it's been the backhoe loader that's fallen away from being a very high volume product to still selling in decent numbers, but certainly not what it was. You've seen a bit of growth in telescopic handler sales in North America, but they haven't really caught on to the same extent that they have in Europe. But as I said, the main impact of compact track loaders is to replace the wheeled skid steer loader. In North America, in general, it's a little bit more rental oriented than perhaps we are in Europe, and rental is consistently the biggest customer group. Again, this is one of those things that is not necessarily driven by a long-term trend towards rental or not. It's about a little bit, what type of work is underway, and whether that is the type of equipment that tends to be owned more by contractors or more by rental. So looking ahead as we move into a more sort of infrastructure focused period, we would expect a little bit of uptick in the contractor owned equipment, as those larger machines do tend to be a little bit more contractor rather than rental owned. Rental is obviously very big for compact equipment. Again, extraction shown by this gold bar is relatively small in unit terms, although it's much bigger in value terms. And the areas, the secondary areas that are more noticeable in volume terms, again, things like landscaping and agriculture, but those are, of course, activities that tend to favour the smaller machines. So if you looked in value terms, they would be less significant. So I'm going to move on to China now, which, as I said at the start, has moved to a completely different kind of set of stimulus and drivers than we've seen in pretty much the rest of the world. Very high volumes in 20 and 21, and then really quite a horrible year last year. So really China's, possibly not bottomed out just yet, but is hopefully getting through the worst of it. So yeah, if you look back at the history of the Chinese market, it's hugely volatile. In 2010 and 2011, there was a huge amount of stimulus spending money coming into the market in response to the global financial crisis, which was phenomenal. Nearly 500,000 machines sold 2 years running. And that more or less enabled China to build the world's biggest high-speed rail network overnight. So, kudos to them for doing it. But one of the problems with the Chinese market is this stimulus money comes on stream very, very quickly, burns very brightly, and then kind of disappears just as quickly. So after that huge spike, you had much less activity, and you had all these new machines or newish machines sitting around in the market with not much to do. And that was a very big barrier to new equipment sales. So the next 5 years in China were pretty miserable. The market just fell and fell, and we thought it was at the bottom, and then it fell some more. And it was only really in the late 2010s, when the One Belt, One Road initiative got going, that things started to pick up again, partly because of the higher construction activity that was there, but also because these machines from the stimulus peak were nearing the end of their lives anyway and needed replacement. So that brought the Chinese market back up in 18 and 19 particularly. And then in 2020, the government was very quick to, again, get stimulus spending in place, more on a provincial than a national level this time. And again, you saw a big spike in sales. At the time, we were reasonably confident that you wouldn't have a repeat of this collapse that was a feature of the early 2010s. We felt the market had changed structurally quite a lot, that there was a lot more repair and maintenance rather than new build work, which should have been a steadier stream, and that you've also seen construction equipment move out into other areas. That is the case, and we still believe there's been a structural change in the market. But the problem was last year in China, it just didn't get over COVID. Of course, there are a lot of additional lockdowns in major cities, which really hurt the economy in general, and construction equipment is a part of that. But more pertinent to the construction equipment world was the bubble that has been building in the Chinese real estate sector, for decades, arguably, finally burst with the debt defaults at Evergrande, the biggest real estate developer in China, and the contagion that spread throughout the sector. So it's really the real estate turmoil which caused this major downturn, and which is the reason we're forecasting a pretty slow and modest recovery by Chinese standards. It's not really a problem the Chinese government can fix with more stimulus or any of the normal levers it pulls. It's just a case that the real estate sector has to restructure. These bad debts have to get worked out, and then house prices have to start rising again to a point where people want to build and develop before construction equipment sales follow to execute those projects. So we actually see a further, although thankfully more modest, downturn this year as the real estate sector still kind of comes out of the problems it's had. And then hopefully from 2024 onwards, we should see a bit of an improvement in sales. As a forecaster, I have lots of caveats that I tell to my clients. In China, it's even more complicated than that, because the government is so active in the economy that things can change very, very quickly if they elect to sort of take certain initiatives to stimulate the economy or to slow it down. So this forecast for China is what we think now, knowing what we know today. the Chinese government, unfortunately, doesn't run its economic policy past us before it does things. So we don't really know what will happen next, and things could happen which might change the forecast. So this is what we think now. It could be different next week. The market structure in China has changed and has kind of moved away from its traditional products. Historically in China, all the big state-owned companies made wheel loaders. There were excavators available, but the indigenous ones back in the 80s and 90s were quite poor. So everything was done with a wheel loader, and at times the volumes were staggering. From the mid to late 90s onwards, you started to get the international OEMs entering the Chinese market, setting up wholly owned subsidiaries or more commonly joint ventures. And they were very much focused around crawler excavators. So that did feed crawler excavators in. They started to take more of a share. And then in the 2010s, you reached a point where the indigenous manufacturers were also making perfectly good products as well. And that helped stimulate and accelerate the uptake of crawler excavators. At the same time, you had mini excavators starting to be launched and really grow in popularity. That's somewhat surprising. You don't often see that in even these medium income emerging markets, because mini excavators really compete with manual labor. And of course, in China, there's really historically been no shortage of manual labor. But as wages go up, the economic argument tips towards mechanization. And you also have other factors playing into it. I mean, again, going back to this diversification point I made, mini excavators are used quite a lot in agriculture now in China. And that's one of the things we like about the market, that it's not purely reliant on construction anymore. And that's happened because, as in many parts of the world, there's an aging workforce in agriculture. There's internal migration from rural areas to cities. And so the industry has to mechanize or adopt new practices just to stay productive. So we have seen this change with excavators being adopted a lot more widely in China. And in the other areas, there is obviously still a lot of infrastructure building in China, although it is pivoting to new build. So there are still a lot of compactors and pavers and graders sold for things like road and railway construction, but their relative proportion has shrunk as it's pivoting a little bit more towards a repair and maintenance market. The structure of the market in China is probably more what you would expect in an emerging market. By far and away, it's contractors which buy the most equipment. There is a rental sector in China, but it's relatively small. Growing a little bit, it would seem, but it's still very much limited to the bigger cities on the East Coast. Extraction is very big in unit terms, much bigger than we saw in those European and North American slides. And it's still kind of a fairly unconsolidated industry in China, although there have been changes. But essentially, you have a lot of small and medium-sized production facilities scattered around. So that does consume more slightly smaller machines than you would see in a developed market. And as I said, agriculture is quite important and has grown in importance. We feel it will continue to do so, although that is probably a bit of fat finger in 2027. That doesn't look quite right. But I think the direction of travel is pretty clear. The last region I'm going to talk about in depth is India. It has had a little bit of a tough time in the last couple of years. We're very bullish at Off-Highway Research about India. We think the long-term promise is there. The money is there to invest in infrastructure. And yeah, over a long time span, it will be a strong market, but goodness knows there are bumps in the roads. The last really good year in India was 2018, when the market nearly hit 100,000 units. So, at that point, that was almost 10% of the global market in India. General elections in India are pretty disrupted because as soon as they're called, no one can award public works contracts, as that can be seen as a way of swaying the electorate. So you have a period of 2 or 3 months where no work is awarded. So that obviously affects equipment sales. Then the election process takes a little while, and then you've got to form a government. So it's a couple more weeks, and that all happens in May, and then the monsoon hits. So it really does scupper things for the year. So that's why there was a downturn in 2019, even though the markets were very strong and the fundamentals were strong. The investment in road building and other infrastructure, which came with Prime Minister Modi, those plans were really continuing, but that sort of particular quirk of India saw things fall. Then, of course, in 2020, COVID hit and things improved a bit in 2021, but there were further waves of infection. And things were looking okay in 2022, but really it was a country where inflation really bit quite hard last year. India imports a lot of its oil and a fair proportion of its energy as well. So things like a rising oil price really hit the Indian economy quite hard. We are seeing those things kind of being worked through now. So we're more confident that there'll be growth in 2023. And then in 2024, there's another election and there's always a downturn. But after that, we would expect further growth. So it's been a bit of a stuttering return to health in the Indian market. And there will be stutters in the next year to 18 months. But overall, I mean, I would say the mood in India right now is very, very strong. There is a lot of confidence about. I was at the Balmacon Expo show back in January in the Delhi area, and the mood was as buoyant as I can remember it. And that's backed up by people being quite forthright about the number of machines they're selling and the number they plan to sell. The structure in India is very odd. Backhoe loaders at times have accounted for 50% of the market by volume. And that really is a tribute to what JCB has done in the market, having the vision to get in there early in 1979 and really build the market for backhoe loaders, which is now phenomenal. Even though there are some bumps and crawler excavators are growing in acceptance, it's still the case that more backhoe loaders are sold in India than the rest of the world combined. And JCB is a very powerful force in that. But we're seeing that as contractors kind of mature and consolidate and take on bigger projects, there's obviously a scale of project that a backhoe loader can't handle. So there is a bit of a migration to bigger machines, particularly crawler excavators for these bigger infrastructure jobs. And there's also a very strong paver and compactor market in India, because although infrastructure has spread to other sectors, it's still very much about road building. The mobile crane market is very big, but it's dominated by locally built pick and carry cranes, which is not really accessible to international manufacturers. And the market for traditional mobile cranes like all-terrain and crawler cranes is relatively small, although at times it's quite buoyant. Compact equipment, mini excavators and skid steer loaders, there is a bit of growth there, but the numbers are quite small. And this goes back to this thing of the competition with manual labor. And of course, in India, there is a lot of cheap manual labor available. So the scope for compact equipment to grow is a bit limited, but it's there, it is growing. But even though the growth is quite strong, the numbers are quite low. And it's also quite a small wheel loader market, purely because there are so many backhoe loaders around. So that tends to be the sort of the default loading shovel for small to mid-sized projects. The market structure in India is odd, and it's not what you would expect. There's a huge presence of rental companies, but it is pretty much entirely the mom and pop rental companies. When we did this analysis, when we first did it about a year, 18 months ago, I was very questioning of these figures, but absolutely they are rental companies. They're not contractors that are renting out their spare machines to their peers. They are companies that buy machines purely to rent them to contractors. But they're not rental companies as we would understand them. There are no real national chains in India. Probably the biggest national recognizable chain is the Cat Rental Store, in fact. these are very small, very local companies, but that's just the way the market has evolved. Contractors don't own a huge amount of equipment themselves, particularly smaller contractors. It is owned by the rental companies. Extraction is pretty big in India, relatively compared to what we see in Europe and North America. And again, it does tend to be the larger equipment. And there are some small sectors. The public sector is still a reasonable size in India. You do get local authorities buying a few machines, but that is kind of squeezing out, I would say, over a period of time, and it is moving a little bit more towards the private sector. And the other thing that's different to the other countries that we've seen is that agriculture is very small at the moment in India. It's not to say it's not a mechanized market, because there are a phenomenal number of tractors sold in India. They're quite cheap, low-powered machines. So that's the main sort of mechanical aid to agriculture. And they're a bit of a barrier to the adoption of any construction equipment. But there is potential there, I would say, maybe some growth in the future. So as I said at the start, we're seeing a soft landing. And just to kind of put a bit of flesh on those bones, this year, we're reasonably confident it will be a strong year and that there'll be good volumes, simply because of the size of the order books that many manufacturers have. What that means, obviously, is, I think the thing to watch is the new order intake. I think, you know, the new order intake, I think, will see the backlog come down. That's not necessarily a reason to panic, I don't think, because I think it's just new orders coming back to a natural level and lead times getting more normal and more acceptable. But yes, I think new orders is the one to kind of keep an eye on, because that would be the first indicator of whether there's a downturn or what the severity of it would be. But over the medium term, we've obviously come out of the COVID influence period, and we should see all those issues finally worked out this year. So it kind of comes back round to the more normal economic and geopolitical factors that we're seeing. There are a couple of issues that we're facing now as an industry that maybe we haven't seen before. We believe these scarcity and component supply issues will remain to a certain extent. Partly, there's a specific issue around semiconductors, which we don't see being solved very, very quickly, because it's just an issue about the global capacity to produce the type of semiconductors that are used in things like ECUs. But there are also issues around the politics of trade barriers and tariffs that are seeing a little bit more reshoring and onshoring. I think one thing that COVID showed us is that the system of globalization that had built up was possibly a little bit fragile. So if you kind of combine the shock of COVID with the trade tensions that are building up in the world and have been built up for the last 5 years, we're going to see a bit of a change in industrial footprints and supplier footprints as a result, which frankly has good and bad things about it. I think it'll make supply chains a little bit more resilient, but it'll also, because it's to a certain extent a pulling up of the drawbridges, it possibly makes the markets a little bit more closed and less competitive for the customer. And of course, we're struggling through the high inflation and increases in interest rates. You know, greater minds than mine kind of feel that those problems are starting to diminish, and 2022 would have been the peak year for that. But it's something that clearly hasn't played out yet. We're not out of the woods yet. And I think the other point to make is we're clearly not going to go back to the situation that we had from the collapse of Lehman Brothers onwards, of virtually zero interest rates for 14, 15 years. We're not going to get back down to that. We're going to go back into a kind of a more normal period of inflation and interest rates. Hopefully a lot lower inflation than we're experiencing now, but certainly that era of free money is a thing of the past now. So building that all into our forecast, these light blue columns are how we see things in the future. So we saw a bit of a downturn, as I said at the start, last year, due entirely to what happened in China, with the Chinese market falling a little bit more this year, and other markets at best stabilizing at a high level, but probably coming down a bit. We will see a further fall in global equipment sales of, the sort of 5 to 10% range, I would think. But the point I would make is that, that volume is still very, very good on a historic basis. And indeed, the further mild downturns that we see in 24 and 25 will keep that market above 1 million units per year, which prior to this upturn that, the start of this cycle, that had only ever happened twice before. So, overall, and this really is my definition of a soft landing, yes, there's a downturn, but volumes will remain historically good. And we're not really expecting a double-digit downturn. We're expecting these relatively mild incremental year-on-year falls. But as I said, I'm a forecaster. I'd be foolish if I didn't put caveats on that. And that is with the caveat of this is what we think today, knowing what we know now. I think if you look out around the world, there are things that could happen which would make the economic situation worse if inflation doesn't come under control, if interest rates have to go up a lot further in more steps than the markets are expecting, if the war in the Ukraine escalates or drags out, you name it, if the trade tensions get worse. So there are many things in the world that I think could negatively impact economies. There aren't many things that we see that we think, oh, if that happens, it'll be great, things will get better. Most of the concerns are on the downside. So while this is our forecast and we stand by it, certainly for this week, I think if we are going to revise it in the future in light of new information, it would be to revise it downwards. So this year, as I said, soft landing. You're probably tired of me saying soft landing, but the key point, I think, is this pivot somewhat towards infrastructure and larger equipment types, and the real cooling and where we'll see the volumes fall away is in the smaller machines in house building. Non-residential building, I've said there it looks relatively weak, and that's more the case in Europe. That's not the case everywhere in the world. It's actually looking reasonably buoyant in North America, for example. But the point about non-residential building, as far as the machine types that we covered off Highway Research, is it doesn't have a huge impact. If you're in the tower crane business, if you make foundation equipment or things like hoists, it's probably going to affect you more. And the medium term, again, another soft landing there. I hope someone's keeping count. But as I said, when that graph was up, we feel that, okay, if you look at construction equipment sales over the long term, the curve always goes up. There are these cycles along the way, and sometimes they're quite vicious. But the point is that overall the market grows year on year, or decade on decade, I should say, as the world's population grows, as the world's population needs more infrastructure and places to live. So we expect the average size or the natural size of the market to move up year on year with every cycle. And I think, what I've shown in that graph is that is happening. The headwinds we've discussed, they are what they are. I think the uncertainty right now is probably less than it was a year ago. If you kind of think back to where we were early spring, where the war in Ukraine was new, and people were suddenly looking at inflation and going, wow, that's really getting out of hand. Those tensions are a little bit lower, and the industry has adapted somewhat. So it's not all doom and gloom. I think we have worked through it to a certain extent, but as I said, the uncertainties are on the downside. And if there is going to be a revision in our forecasts, it would probably be down rather than up. So I'm going to pause for breath there and turn off the screen sharing. If you'd like to get in contact following this presentation, you have all my details there, and the slides will be available. But I'd be very pleased to take any questions you have, or anything that's come up on the chat.
Thanks, Chris. That was excellent, as always. I think you've talked yourself up to the end of the show.
Oh, well done, me.
But yeah, no, that was really good. I mean, it's I like soft landing. I think you might have mentioned that.
I dropped it in. Yeah.
Did you? Yeah, I think you got away with it.
Yeah.
And I was going to show some slides about upcoming CEA events, but I don't want to overrun into the AGM. Just to say quickly that the CEA conference has been rescheduled, that we had to cancel because of the train strike. That will now take place on the Plantworks VIP preview day on the 12th of June. And afterwards, there will be the Plantworks Innovation Awards dinner. That's selling out really quickly. And we've got the Dark Destroyer from The Chase, who apparently is very scary on The Chase and a really nice guy in real life. So have a look on the CEA website or drop me an email and I will point you in the right direction. But the conference is free to CEA members, and we've got some really good speakers, particularly focusing on the emerging technologies and use of the existing technologies around connected autonomous plant. And the dinner will give you a chance to mix with the VIPs coming from all kinds of the mega projects, of contractors, of end users of plant in the evening. So thank you very much again, Chris. I'm going to shut up. And if you are not a CEA member, if you could drop off the call now. If you are a CEA member, please do stay on, because our Chief Executive, Sunita Johal, is going to talk you through some interesting changes to the CEA and what we're going to be doing going forwards, as well as all the thrilling things like minutes and matters arising. So thank you very much for joining the Power Hour. Hope you'll join us again at the next one. I'll send you